Good morning, ladies and gentlemen. I'm Isaac Msonte. We are presenting financial performance analysis for Sunbelt Tourism Private Limited Company. We are four of us: Wangsani, Isaac, Dingani, and Kondwani. Next. On our presentation, we are going to have introduction, company profile and background, financial analysis, discussion and recommendations, and finally conclusion. Next. Next slide. Next slide.
Can you hear me?
Okay. COVID-19 took a law on tourism and hospitality sector due to travel restrictions that brought some cancellation of events and the fears of the spread of COVID. This is according to Ahmed and Eto. Ahmed and Eto indicates that financial consequences of pandemic on the sector resulted in the drop of equity prices, earnings before tax, and financial liquidity, leaving many companies in the industry with uncertainty financial outlook. One of the Malawi top tourism companies, the Sunbelt Limited, so-called Sunbelt, acknowledges the 2019 COVID detrimental effect on the business. In trying to understand the extent of pandemic's impact, this presentation analyzes the Sunbelt performance before COVID, during COVID, and after COVID periods. The management choices regarding operations, investments, financing, and dividend distribution also are going to be examined as acting moderator, with recognition that maximization of companies' shareholders is a primary objective. Next slide. Yeah, the company profile. Sunbelt was listed in 2002 by Malawi Stock of Exchange. It has a staffing profile of 722 employees with 9 hotels in all cities of Malawi. That's Blantyre, Lilongwe, and Nzuzu, and in the lakeshore areas. The shareholding for the company, 71%, which is a major shareholder, is the Malawi government, followed by Press Corporation with 15%, and the general public sharing the 14%. Next slide. Why doing analysis? Analysis helps to it's an evidence-based decision-making tool. It helps to monitor the growth or the profits of an organization, but also you are able to predict the future of the organization. You are able to know the trends and the strategies to be used. But it also helps to optimize the operation of the organization. It also improves the outcome of the film, and it provides the valuable insights of the organization. Next. The span of the analysis is from 2019 to 2021 in order for us to have a trend of what we are analyzing. And the selection of the company, it was based on the availability of data. The parameters that we are going to look at, we are looking at the financial statements, which includes income statement, where we are able to see the flow of to see how the organization, if the organization was able to make profits or not, balance sheet, knowing the position of the company financially, and the cash flow, how much the cash came into the organization and how much cash went into out of the organization. And we are going to have the analysis using vertical analysis as well as the horizontal analysis. The data interpretation, we are going to use ratios. Amongst them, there is gross profit margin, net profit margin, return on capital employed, gearing, and as the test ratio. Next slide. May I hand over to Co to proceed?
All right, thanks, Isaac. So one of the parameters that we looked at was the income statement. So we focused on profitability ratios. So profitability ratio, according to Watson, demonstrates management's success in generating profit for the organization. So the measures and the ratios are comparable across the time period that has been highlighted. But in the course of the discussion, we'll also try to look at how another company within the industry also fared. So looking just at the magnitude in terms of the absolute figures, you can actually see that for the cost of sales in 2020, there was a slight increase in the cost of sales comparable to 2019. And that was mainly due to reclassification. So we'll get to that in the later slides. So we looked at another ratio, which is return on capital employed. So this actually measures the company's profitability and the efficiency with the capital employed. So looking at the analysis itself, it actually demonstrates a drop in 2020, and this actually means that the company itself was operating under the negative operating profit for that. Next slide, please. All right. So we also try to look at the other measures. So that's the gross profit margin and also the net profit margin. So the income statement is actually highlighting a decrease. Mainly, we're actually seeing this trend for 2020. And the decline overall is as a result in the decrease in proportion from 52% to 16.7% in the cost of sales. So that's against revenue, which translates now to an increase in the cost of sales. So the increase, as I touched on in the previous slide, is mainly due to the reclassification of the staff costs that were now changed to from administrative and other expenses to the cost of sales. So the 37% decrease in the cost of sales revenue ratio between the 2020 and 2021 translated now to a 17% increase in the cost of sales in 2021. Next slide, please. So before we actually get to the balance sheet itself, it is worth noting that the improvement that we saw in the income statement, they are actually now associated with ease on the restrictions that were there for COVID-19. So there were other issues like the hotel occupancy rates, which actually are increased, and also some other investments like construction of the waterfront hotel in Salima, which translated now into profits for the latter year. Next slide, and let me hand it over to Dingani.
Thank you very much, Ko. I'm here to present on the balance statement analysis. So a balance statement is a sheet. A balance sheet is one of the most basic financial statements that a business uses to demonstrate their financial health and stability. Now, this balance sheet will give us a snapshot of the organization's assets, liabilities, and shareholders' equity at a given point in time, allowing stakeholders to assess the firm's financial status. We will analyze the company's balance sheet using four ratios: the current ratio, quick ratio, gearing ratio, return equity. Now, on the current ratio, in this current ratio, we measure whether the company can turn over in short-term liabilities. In the year 2019, as you can see on the graph, and year 2020, Sunbed had a current ratio of over 2.5, while in 2021, the ratio decreased to 1.3. Current ratio, a quick ratio of 0.9 in 2021, which is a decrease from a ratio of 1.56 in 2020 and 1.81 in 2019. As shown on the graph, this decline can be attributed to the increase in payables, medium-term loans, overdraft to cover the company's construction projects in the year 2021. Next slide, please. So we went further to analyze the gearing ratio. We assess the proportion of a company's financing that comes from debt relative to equity. A higher gearing ratio indicates a higher level of debt relative to equity and implies higher financial risk. The company acquired a short which had a gearing ratio of 23%. There has been an increase in the ratio for the past 3 years. Sunbed has a lower financial risk in this situation, despite the increase in gearing ratio. With less debt, the firm may have fewer interest expenditures and financial commitments, allowing it to be more stable during economic downturns. Next slide. Lastly, return on equity compares to net profit after taxes to the equity invested in the company by shareholders. In 2021 and 2019, Sunbed managed to return 2.7 and 11.33 respectively in the stakeholders' investment. This 2019 seemed to be a very good year for investors because it gave 11.3% return on their investment. On the contrary, they lost 4.37% in their investments in 2020. This was due to the loss of profit of 1.1 billion, which was attributed to COVID-19 impacts. However, the return on equity has been relatively low for the past 2 years, which might lead to some investors pulling out of Sunbed Capital Hotel. But on the bright side, we can see that from 2020 to 2021, there's been a substantial change, which might be a trend even in 2022 moving on. Thank you. Over to you, Angisan.
Right. Thank you, Tingani. So I will take you through our analysis on the cash flow statement. So basically, a cash flow statement summarizes a business's cash inflow and outflow. And cash is an essential resource in a business for meeting day-to-day operation costs, for paying loans and paying dividends, and for asset investment. Cash can flow into or out of a business because of either operating activities, investing activities, or financing activities. And I'll take you through ratios that give us information about all those types of activities in Sunbird. Starting with the operating cash flow. So under operating cash flow, we look at two ratios. The first one is operating cash flow ratio. This ratio measures the operating cash flow that is coming in to the current liabilities that Sunbed had. In the year 2019, Sunbed had an operating cash flow that could have covered 90% of their current liabilities. However, there was a drastic change in 2020 where it dropped to 13%, and there was an improvement in the year 2021 to 47%. That also is in line with the other ratio, which is cash flow to share ratio, which measures how much cash flow is being generated for each share. In the year 2019, Sunbed was able to make 10 kwacha per share. In the year 2020, that dropped to 1 kwacha per share, and in the year 2021, it improved to 8 kwacha. The number of ordinary shares remained constant throughout the years, as we can see in the slide. The decline in both ratios, particularly in 2020, can be attributed to 9% less cash revenue. As indicated in the income statement, Sunbed had lower occupancy rates, so their cash flow coming from customers paying cash actually decreased. But however, they also paid out more, about 6% more to their suppliers with cash. But most importantly, there was a 66% increase in interest payments paid with cash. So that entails that in the year 2020, Sunbed was less capable of paying its current liabilities, and it generated less per share, mostly because they were paying more in interests. Moving on to our investing ratios, we're going to look at cash flow to capital expenditure ratio, which measures how much cash is being used or reinvested into the acquisition of long-term assets. As ideally, a company is supposed to have a cash flow to capital expenditure that is at 1 or above 1. But as we can see in all years, that has been below 1. That can mostly be attributed to the construction projects that Sunbed has been doing, constructing a new hotel and the renovating of the Vincent's restaurant in one of their hotels. So this means that the cash flow that has been coming in does not measure up to the expenditures that they've been having. That also means that they've been rapid expansion because of the construction projects. That also indicates that they've been utilizing other sources of capital because the cash hasn't been enough. So that means they've been using other sources. And that has led to a negative investing cash flow throughout the 3 years that we examined. Finally, I'm going to take you through the financing cash flow. And here we can see that financing cash flow has been positive throughout the 3 years that we analyzed. However, it has been declining, which means that we've been getting less loans as the years are going by. And that can be attributed to the completion of most of the projects that Sunbed was working on. So it no longer feels the need to get a lot of loans to finance these projects as they're coming towards an end. To sort of summarize everything that has been discussed in the cash flow statement, overall, throughout the 3 years, there's been a positive net cash flow, which is a good thing. That means that Sunbed has been receiving more money, more cash than the cash that they've been using. In the year 2020, cash flow increased by 66%, which is a bit interesting because, as we indicated, so this is net cash flow, but as we indicated, the operating cash flow actually decreased, but the net cash flow increased, and that can be attributed to less investing. So they spent about 31% less in investing in the year 2020, and because of that, the net cash flow actually increased. So the impact of COVID-19 cash flow wise wasn't as big because it only impacted 10% of the operating cash flow. Mostly the cash flow has been impacted by the construction projects that Sunbed has been doing. And as we can see, Sunbed is in a growing phase or a growth phase, where the investing and financing is sort of decreasing, and however the operating cash flow is increasing, as they're starting to realize profits from all of the constructions that they've been doing. Thank you. I'll pass it on to Isaac. Thank you.
Yeah, looking at what we have discussed, we can see that the shareholders' wealth was increased by cash flow, investing in long-term infrastructure projects. Management also used survival as a key objective during the pandemic to sustain the business. Other strategies which were employed include the introduction of promotions, brand visibility, corporate social responsibility, guest satisfactory survey, and the introduction of mystery guests in hotels to assess the attitudes and the performance of staff at all hotels. We can see that finance, the project was financed using more debt because I think management assessed that the projects were not very risky. Dividends were not given in 2020 as well as 2021. Comparing with Blantyre hotels, we can see that Blantyre hotels, they had a loss of earning per share of 590 million in 2020 and the 646 million in 2021, and they did not issue dividend in 2019, and they issued a dividend of 20 tamba per share in 2019, no dividend in 2020 and 2021. Next slide. Yeah, in recommendation, we are recommending that Sunbed should balance between retaining profits and declaring dividend in order to increase return on equity and the cash flow per share. They should also work on improving gearing ratio by minimizing borrowing and negotiating for reasonable interest rates when financing projects using borrowing funds. They should also monitor cash flow by reducing receivables days and lobbying for increasing payable days. And also, they should minimize or control the cost of sales and administrative costs. Next slide. In conclusion, we can say that COVID-19 greatly affected performance of the company, but the board and management managed to they were able to manage the situation by employing different strategies. As the company is going through a rapid growing phase, it is very important that effective communication to shareholders is practiced to ensure that shareholders are aware why some developments are happening, like development of not giving dividends. But all in all, we can say that Sunbelt has fared well on itself as well as in the market share, and it continues to be a leading company in the tourism sector in Malawi. Thank you for listening. Thank you.
Okay, I think we can open up to questions.
I think there's a hand from Kumbo,
Right.
and there's also a hand from Kevin.
Okay, so my quick question is, so what would you advise the investor? Is it a good time to invest when the company is retaining earnings and not giving dividends?
So maybe we can also just take the other one from Kevin, then we'll finish up with Trace.
Okay, just for clarity's sake, why do you think it's what do you think it is restrictions improve the operations of Sunbelt?
All right, so maybe I can also come in. So colleagues, thank you very much for a very good presentation, detailed one. So from the presentation, you indicated that indeed there were good cash flows in 2020. However, the dividends were not declared. Why is such the case? Thank you.
Okay, so I'll begin with answering Tracy's question, and I think my colleagues would proceed with answering the other two questions. So Tracy is asking why dividends were not declared in 2020 when we saw that cash flow was actually good in the year 2020. So we all know that dividends, cash flow is used for paying dividends. So why was that not done? So that was not done for two reasons. The first one was this was still during the pandemic. So there were still a lot of uncertainties for the future. So every wise management would try to hold on to as much cash as possible to make sure that, especially during a pandemic, to make sure that in the coming future or in the coming year, that at least have enough cash to finance their operations. And then secondly, we noticed that there was a loss declared in that year, despite having good cash flow. And according to the policy, once a loss is declared, the dividends are not declared. So yeah, those are the two reasons why dividends were not declared. Thank you.
All right, so I think maybe just to also respond to Kumbo's question on whether it's the right time for investments. So I think looking at the analysis itself, we can actually say, yes, this is possibly the right time to invest, because the company has actually demonstrated that it's actually recovering from like some huge loss, but then they've actually started investing by the construction and also some of the renovations. So you can actually see that some of the statistics, they're actually jumping from a loss, and they are actually demonstrating that they're demonstrating a positive trend. So of which, whatever measures that were put in place possibly work for the company itself, and this could possibly be a good time to invest. So maybe Isaac, if you could take the one on clarification on the COVID restrictions.
Thank you. Quickly, major contributor for revenue for Sunbelt, it's accommodation and the reception of activities. So during the restrictions, it means that the company was restricted to the cash flow. So the restriction, the openness or the easing of restrictions opened a door of revenue for organization. So indeed, it improved the revenue and performance of organization after the restrictions. Thank you.
Ingadi, anything, any addition?
No, that's okay. With time even, I think we are good.
All right. So we can't see any more questions in the chat and any more hands. So I think maybe we'll stop at that. Thank you, colleagues, for listening in.
Thank you so much.